All right, so institutional buying and selling zones is something that not only retail traders are concerned about, but also other traders as well, like high frequency traders, algorithmic traders, and other institutionals. But before talking about institutional buying and selling zones, we have to know how institutions actually trade. What are their characteristics that we have to know before actually finding out institutional buying and selling zones? So the first thing is that institutions, they trade on information. So if they take a trade, they will not just take it randomly based on technical analysis. Their trades will be driven by information. And what do I mean by information? So I mean that they will look at economy, like macroeconomy, how well the interest are doing, how well the inflation is doing, what all of these economic reports are saying, right? And then they will do their analysis, and then they will take their positions. And that's how they trade. If there is someone who's actually telling you that there is some magical trend line or magical support or resistance that is there, and institutionals are buying off of that level, that is a complete lie. You should not trust that person. So the first thing first, their trade is based on information. So to find out like what information they're saying, is really easy. All you have to do is to learn macroeconomics, what we call fundamental analysis. You have to learn what fundamental analysis is, what these economic indicators means, like the macroeconomics concepts of supply and demand and monetary policy, etc., etc. So the second characteristic of institutions is that because of the large volume of their trade, they have to break their trade down into small pieces, right? They cannot just go and place an order in the market as we retail traders do, right? They cannot just go and buy into the market. If they do that, let's say if they come in, this I have opened the charts of GBP USD, and they come and they just buy GBP USD, that is going to have an impact on the market, right? If they buy, the market is going to move. They can move the market because of the volume and the size of their trades. So what they have to do is that they actually have to break their trades down into small pieces, right? Let's say they want to place $100 million order into the market. They will break their trade down into $1 million orders, and then they will start taking their positions, right? They will just start buying 1 million, 1 million, 1 million, 1 million, etc., etc., etc. And that is how they are going to buy, right? So whenever you see the market ranging, you should know that there is some institutional activity getting involved. And if you are getting a range, before some major economic data release, like the NFP or CPI report, that is your institutional orders being filled into the market. And there is another thing that I want to tell you, that I want to talk about, is that institutions, they don't like their orders to be found by other traders, like high frequency traders, which makes up like algorithmic trading. So like high frequency trading is also like a form of algorithmic trading, but the difference between algorithmic trading and high frequency trading is that high frequency trading is like a really fast trading, right? So like if there is a high frequency algorithm out there, it will fill in like thousands and thousands of order in the blink of an eye, right? It's just like like the speed of light. They just fill in orders. And the algorithmic trading is more of information driven, like there will be algorithms who will wait for some economic news, right? And that is the reason you see that whenever there is news, the market just moves in one way. So that is your algorithmic traders algorithms working, because they get information so fast, right? They just fill in their orders because they take advantage of their speed, and they just fill in the orders, and their algorithms can interpret the data successfully, and they just take positions in that direction, right? So the second thing that you have to know is that they don't like their orders to be found by other traders. So let's say that if institutions start to buy, you will not know. Even other high frequency traders or other algorithmic traders, they wouldn't know that institutions are getting involved. It is only after a period of time that we will know that okay, institutions are getting involved into the trade, into the markets, and their order filling can last from few hours to few days based on how much they want to move the market and based on overall outlook of the economy of a country, right? Let's say there is talks about Fed's increasing interest rates, and of course we don't know, right? They know, institutions know these news before us, so they will start range, and as soon as the news comes out, the market will move, and like they just ride their profits, they just take their profit. So they don't like their orders to be found out by other traders if they are trading, because what it does is that it increases their cost of filling in, uh, like, because of the size of the institutional orders. There is also liquidity concerns and so many other things as well that they have to keep an eye on. So even other high frequency traders, they will know it after a few hours, right? So what some high frequency traders do is that they take positions against the institutions. uh, uh, it can last from like 1 hour to 4 hours maybe, right? They just take their positions against the institutions. I'm like, no one knows exactly, but based on the research, it has been found that they take positions against the institution, and then they take positions in the direction of the institutions. So as retail traders, what we can do, so there is also another thing that you have to really keep an eye on, and it's been, I'm not saying it, like all of the research papers are saying it, is that the institution orders, they institutions take their orders either before the market open or at the close of the market open, right? So let's say if we are talking about the Forex or any pairs, like gold, etc., they will take their trades, they will place their orders in the Asian range, and when the Asia will open, they will place their trade, because like there is less volume, more liquidity, and other markets like the London is closed and Y is closed, so it's easier for them to take their trades at that period, right? So it's either before the session or it's at the close of the session. So there's a really easy way to find it, right? Of course, no one knows it. There is high probability. There's there's a really low chance that you will ever find where institutions are. But this is based on research. We work in probabilities, and we can only increase our probability. So the first thing that you're gonna do, if you want to find institutional orders, or if you want to take your trades in institutional orders, the first thing that you have to do is to understand fundamental analysis, right? So let's say this is a trade that I took today on Monday. So fundamentally, dollar is getting weaker because of the talks of Fed's pausing the rate for the May meeting. And what do I mean by that is that the market right now is pricing in a pause for May, right? So when the Fed's pause, that means that dollar gets weaker, and that is why you see all of these pairs going bullish, like the dollar getting weaker. So GBP USD will appreciate. So the first thing that I want you to do is to take volume profile, right? And when the day starts till the London open, so this is London open right here, right? So here it shows volume. So if you see a candle or any order block in here, or any support, whatever you want to call it, just take it, right? And mark it. So now you know that, okay, There is high volume here, the price was ranging here, so there was some institutional activity, and if your fundamental analysis supports you should definitely go for the trade. Okay, so this right here, I did it. Okay, this is my order block, I marked it, right? So right at NY open, this is NY open right here. The market has to take liquidity as well. We will talk about liquidity. There is some conventional views about liquidity, which is that the market makers, what they do is that they take your stops, but that's not really the case. No market maker is actually worried about your 10 lot stop loss. They don't care about your $1,000. So that is also, we will talk about liquidity in a later video in detail with proof, not just random saying. With proof, we will go have a look at some research papers about the markets. What do they mean exactly by liquidity taking, right? So of course you have to keep an eye on any lows or highs, because that is where there is liquidity at the breaking points. So just make sure that if you want to take buy, you take some sell stops before going up. So mark the liquidity zones, the sell stops right here. There is our order block, price comes in, taps into our order block, I take the trade, stops just below this candle, TP is up here at the next level of consolidation or above any high, or whatever your take profit is. You can also just go for right here or right here as well, but I like to trade a mix of a swing to day trading. Alrighty, so here when I took this trade, what were my probabilities of winning this trade, right? So the first thing first is that I identified institutional orders, although I don't know for sure, but this is their characteristic, is that they stake up their orders, they break them down into small pieces, right? And some of their orders don't get filled. So after high frequency traders find their orders after a few hours, right, they will just work as liquidity providers to them. They will take the market down, fill in their orders, and then they will take the market in its direction. So right here I had a fundamental confluence. There was this order block confluence, liquidity confluence, like break, whatever your analysis is, this is how I trade. And then the most important thing is the fundamental confluence. That is that US dollar is weaker and GBP USD is meant to go up, right? So as soon as price comes and taps into this order, I take the trade, stops below here, and I just let it run, and it has worked pretty much great here, right? I took a trade, it was a 1-4 trade, RR, risking 1%, making 4%, really cool trade. So that is how you can find institutional orders. So the thing that you have to keep in mind is that they like to trade before the market opens and at the close of the market. And if you can identify it, if you go do some like practice on it, then you will really find out that these things work, that the market actually comes down and taps into these areas and then just goes. So this was it for today's video. I hope you learned something, you found some value in it, and I'll see you the next time.